Welcome everyone. In this video, we'll be continuing our conversation about financial statements, but now we're really focusing on, as you probably guessed by now, cash flow. So our specific objective is discussing the cash flow identity and helping us understand and calculate even the cash flow statement. But because there is some reference to the other statements, I will provide, for instance, the income statement. If you want to take a screenshot, you're welcome to do that. And also the balance sheet. So if you want to take a screenshot of these, just so you can have a reference point for where some of these numbers might be coming from. Let's start with the cash flow identity. So similar to the accounting identity, the cash flow identity states that the cash flow from the left-hand side, which is our cash flow from assets, is equal to the cash flow on the right-hand side. Okay, so we have to consider the cash flow going to creditors and the cash flow going to the owners. So let's take a look at it from a bigger picture, a little more detail. Again, still we have three components, but it's going to help us apply some of these equations to calculate these components. Now let's start with the cash flow from assets. And even within the cash flow from assets, there's three parts we need to consider. First is our operating cash flow, so the cash coming from our operations. Next is the net capital spending, right? So are we making any long-term spending investments on our assets? And then finally, a change in net working capital. So considering our short-term spending. So those are really the three parts we need to consider. Once we have those three, we're going to apply this equation. Again, think about it as all the cash coming in from the operation. If we are spending anything on assets, then we have to subtract that. And the same goes for short-term spending as well. Now, once we have our cash flow from assets, we can move on to other components. But here is just a reminder of some of the equations we'll be using, right? So to calculate operating cash flow, we can use one or the other of these equations. Figuring out our net capital spending, we're going to be determining the ending and the beginning of our next fixed assets. And of course, we have to add back our non-cash expense of depreciation. And finally, figuring out the change in net working capital, we're going to be looking at the ending and beginning of our net working capital. You may wonder, how do you calculate net working capital? Well, if you recall, net working capital is the current assets minus the current liabilities. So there's some equations there for you. Let's begin with the operating cash flow. Here we can see that we can calculate the operating cash flow either by taking the net income, adding back depreciation and interest, or we can use operating cash flow using the earnings before interest and expense, adding depreciation, and subtracting taxes. So if you reference the income statement, you can calculate that and you should arrive at the same number. So that's how we calculate operating cash flow. Next part is the net capital spending. So what do we mean by ending minus beginning? Well, ending is always going to be our most current period. So in this case, 2017. If we take our 2017 net fixed assets, which is our total long-term assets of 2017, and we subtract our 2016, which we see here, okay, that's going to be our ending minus our beginning, next fixed assets. And then we just have to add back depreciation, which is that non-cash expense. Now, we don't actually see depreciation on our balance sheet because we recognize it's a net property, plant, and equipment. So it's already been accounted for, but we're just going to assume that that's the figure for depreciation. And this is how we arrive at the net capital spending. Finally, we have the final part of our first component, which is the change in net working capital. And we're going to look at 2017 minus 2016 net working capital in this case. So again, if we look at 2017, we're going to be considering the total current assets minus the total current liabilities. And we'll be considering the same for 2016 numbers. once we have the once we have the net working capital for both years, we can find the change by subtracting the two. So we've got all three parts for the cash flow of assets, and we can put it together now. Reminder, this is how we determine cash flow from assets. So once we put it all together, we get our final figure. So that's part one of the components. Let's move on to the second component, which is the cash flow to creditors. So in terms of the second component, what this represents is how much money we need to spend for our long-term liabilities. How much is being returned back to the debt that we owe, right? Now, whenever we're borrowing money, we always have to think about interest. So we're always going to pay interest, but we also might take on new borrowing as well. And that's really what this cash flow to credit equation considers. So we have the interest that we have to pay, and we also have to consider any net new borrowing from creditors. Now, interest, again, we've referenced the income statement. We can see that. But the net new borrowing, if we take a look at our balance sheet, we can reference that. And really, it's going to be our long-term liability of the 2017, which is our ending, and our beginning of, which is our 2016. So if we subtract these numbers, we see our change here. So it does look like there was a decrease in long-term liabilities. Once we have those two figures, again, remember the 239 is from our income statement. And if we reference the balance sheet here, we get the 378. So that gives us our figure for the cash flow to creditors. So that's how much cash is going to our creditors. Okay, and finally, we need to think about our owners. So how much cash flow to the owners are we getting? So how do we do that? Well, there's two components. We have our dividends, right? So are we paying out any dividends back to our owners? And also, are we getting any additional cash from our owners in terms of common stock? Okay, so again, dividends is given to us, right? And if you looked at the statement of retained earnings, you can see that. So that's already been given to us in this example. Now, in terms of net new from owners, how do we calculate that? Well, that's really just a change in common stock. So we need to go back and reference the balance sheet, right? And if you recall, there was no change. If you recall, there was no additional investment or additional equity provided by the owners. So that's why you see that there was no change. So once we have those two figures, again, we have to recognize that we are paying out dividends, okay? But we're also not getting any cash coming in from the owners. So that just leaves us with our dividend value. Now we can put it all together, right? So if you recall our cash flow identity, there should be a balance here. And it looks like that is the case. Wonderful. So we've really figured out, or we've looked through the statement or the cash flow identity. And now we kind of want to put it together and understand how that helps us with our statement of cash flows. And really this seems simple, but this actually helps us understand where that money is going in terms of our cash flow statement. Okay, so cash flow from assets is relevant for two activities. First, it's operating activities. Okay, so anything regarding, for instance, the operating cash flow, current assets excluding cash, and the current liabilities, that's going to be in our operating activities. When we look at the cash flow from investments, okay, so again, this bottom area here represents our statement of cash flows. Okay, the second category for our statement of cash flow is our investment activities. And what do we mean by investment activities? Well, really, that's long-term assets. So if you recall our capital spending, now that we calculated from the statement of cash flows, right? That was, I believe, the second part. That's going to be represented here. Okay, so that's why this cash flow from assets can be helpful for both of these activities. Moving on to the final activity, which is the financing activity. The reason why we need to look at both creditors and owners is because there's a combination of these factors represents the financing activities. For instance, how much money we pay in dividends and how much common stock we get, that's relevant from our owners. What's also relevant from our creditors is how much we pay in interest, right? And how much long-term debt we have to pay, okay? Now, it's hard to visualize this, we have a nice statement of cash flows, okay? So again, just as that sort of diagram suggested, on our statement of cash flows, we have one component, which is the cash flow from operating activities. So that's all of these activities here. Then we have our second, which is the cash flow from investing activities, which is really just our capital spending. And then finally, we have the sources and uses of the financing activities, okay, which just as we mentioned was a component of both the creditors and the owners, right? So just as we mentioned, interest, dividends, long-term debt, and common stock, okay, and that gives us our cash flow from financing activities. So most of these numbers we have sort of identified. I will point out a few things though. So if you take a look here, the decrease in current assets, excluding cash, you might wonder how we arrived at this figure. Okay, so if you actually, again, reference your balance sheet and you add up all the changes, excluding cash, in your current assets, you will arrive at this number. You might notice also that it is negative, and you might wonder why, if it's negative, why it's not negative here. Well, it's really important to recognize that the positive here represents the sources of cash, right? So this is money coming in. So if there's a decrease in current assets, excluding cash, what does that mean? Well, it actually means that we probably sold off some of our assets. So that's actually a source of cash. So that's why this is positive, okay? Very similarly, you might ask the same question, well, why is a decrease in current liabilities also not positive? Well, you have to think about a current liability is something that we owe. So if there's a decrease in current liabilities, that means that we actually used, it was a source of cash, we used it. It was a use of cash, okay? So we had to use cash to pay off that liability. So if there's a decrease in liability, that means it's a use of cash, and that's why this is negative, okay? So that's important to understand the difference, and that's how we arrive at this figure here, okay? Very similar here, capital spending. So yes, we invested in long-term assets. If you remember that it increased, so that's good as an investment, but in terms of cash, that's a use of cash. So that's why it's negative. Again, you can go down the list here, interest expense, something that we have to pay, right? Just as dividends. Dividends we're paying, even though we're not paying it maybe to our creditors, we have to pay it to our owners. So we're paying out dividends, which is a use of cash. So all of these are uses of cash, and that's why you see it as negative, okay? And then finally, you see, when we add them all together, this is how we get that negative 65 million that we kind of wondered about in the previous video, right? And then once we have that, we again take a look at our 2016 and 2017 numbers, and we can determine our ending balance as our cash account, okay? So that should help us understand not only the cash flow identity, but help to understand how we create the statement of cash flows. Thanks for watching, and happy financing.